Hello, fellow options trader. In this presentation, we want to discuss when parity is not a true parity trade, or another installment of our married put radioactive structure versus just buying the long call. Or as some critics say, the long call is the same, but better. That's an interesting comment, isn't it? Well, let's get right to it. Many of you know the story. For years, or maybe just the last few months, or even maybe in the last week, you've heard us talk about the benefits of the radioactive trading limited risk structure. And if not, well, what is it? Radioactive trading is a limited risk trading strategy where we focus on limiting risk first. We use a specific structure of a commonly used option structure known as the married put, where we buy stock and buy a put option to ensure the downside. The proper structure allows us to control risk to only single digits even in the absolute worst case scenario. This technique is personally traded by Ernie Zerenner, the president and founder of PowerOptions, myself, Michael Chupka, the director of education here at PowerOptions, and thousands of others. The basic setup: all positions that we open begin with a married put structure for the radioactive trading technique, but done in a specific way to put time on our side. The initial structure follows the three core principles of radioactive trading, which should really apply to any option strategy. It allows us to force an ideal size trade, so we're properly protected from overtrading. We focus on using the ATM bell curve not only for the initial structure, but for the income methods that we'll use to adjust the position afterwards, where we want to sell at the money to maximize the highest time value of the options for a specific security. And when we're buying, we want to buy in the money or out of the money to limit the amount of time value we're paying. We also want to avoid time decay. Since we're buying a protective put option against our stock, we want to buy longer term to allow more time for the stock to move in our direction and less time value decay in those first 90 to 120 days, if we even stay in the position that long. But when we make adjustments, what we call income methods, we want to be selling shorter term to have that time decay work on our favor. What would be a current structure if I was opening a new trade today? Well, on March 27th, 2018, from the RPM report on the Fusion subscription at RadioActiveTrading.com, one of the top results was ETFC, E-Trade. If I was entering a radioactive married put, I'd buy maybe 100 shares of ETFC at $55.65 per share. And at the same time, I'd buy a 2019 January 60 put at $8, which is the natural ask price. So my total invested would be $63.65 per share, or $6,365. Purchasing that 60 strike put gives me a guarantee that I can get $60 back at any time between now and January expiration. So even in the worst case scenario, if E-Trade fell 50% in the next 2 months, I'm only risking $3.65 or $365 per 100 shares, which is 5.7% of the total monetary investment in the position. Here's a profit and loss chart for the position, again using just 100 shares. See that the cost to enter the radioactive married put would be $6,365. Rather than selling a call to cap the gain and leave the downside open, purchasing that 60 put gives me the right to close out of the position at any time, guaranteed to get $60 back. The risk is limited to less than 6%. Now, the initial structure, when you look at it, you see that the cost basis is $63.65. So that's the break even on a stock trading at $55.66. Well, that's only the break even if I held the position all the way to January expiration, made no adjustments against the position, accepted no dividend payments as well. As you can see here, of course, by the curved red line, which is at the halfway point on 823, break-even's just under $60 per share. And all I'm losing when I open this position is the bid-ask spread of the put. If I open this E-Trade RadioActive Married Put position, I could turn around and sell the position right away, sell to close the stock for say 55.65, and sell to close the put for maybe 7.90 or 7.95. The put doesn't go to zero when I purchase it. What are the details of this limited risk structure? Well, it's obvious. It's controlled risk. I have no fear of earnings, market swings, black swan events, or any unexpected event in the stock itself. It is a bullish strategy with unlimited upside profit potential. If I open a radioactive trade, I'm looking for a stock that I feel has the potential to move up 3 to 6% in the first 30 days, and then more of an upside movement in the next 2 to 3 months following that. It is structured as a long-term position, but profits can be taken at any time. If E-Trade gapped up 15% in the next 3 days for whatever reason, I could sell to close the stock, and I could sell to close the put, and the put would still retain 8 or 9 months of time value. I control both legs of the position. And I don't just hope that the stock is going to move up. My research and analysis was based on finding a bullish stock, but now that the structure is entered, we'll use 12 different income methods or adjustments that are discussed in the blueprint to lower that initial at risk, generate income, and potentially cancel all of the risk, which we call bulletproofing. Just by itself, that initial structure we looked at solves the problem of other strategies. On the left, we look at covered calls and naked puts. Income generating strategies allow you to pull in income right away, but they cap the gain on the position, and you still take on a large portion of the risk of just buying the stock outright. If I bought E-Trade at 55.66 and maybe sold the 55.50 strike call 1 or 2 weeks out, I might generate 50 cents, 80 cents, maybe even $1 going a month out in time. If the stock moves up 10%, I don't get any more return than the initial percent if assigned on the covered call. But if the stock falls 10%, I've really only hedged the loss by the premium that was collected for selling the call. Now, leveraged spread trades are a popular way for options investors to generate income with a portion of their portfolio. On the right-hand side, we're looking at a structure of a bull put credit spread. With E-Trade trading at 55.66, I might sell a 1 or 2 week out 54 strike put and buy a 52 strike put. Get a small net credit of maybe 35 or 40 cents for this transaction. The risk is, of course, the difference in the strike prices. But I can set up a vertical spread, bull or bear, that offers a high probability of expiring worthless, 75 or 80% probability based on the trading range of the stock. I may see a double-digit return, an 11 or 12 or 15% return based on the margin I have to put up, the difference in the strike prices times the number of contracts. However, higher probability spread trades do usually come with a 5-to-1, 8-to-1, or even a 10-to-1 risk-reward ratio, meaning in an unexpected event, if I take the full loss on a vertical spread, I may have just wiped out 8 or 10 previous successes. So that structure of the radioactive married put solves the problem of the downside risk of those popular income-generating strategies. But when we look at the basic profit and loss chart, we probably see something that looks very similar to what you've already seen in the past. What does that structure look like? Unlimited upside profit, a limited or known downside risk. Well, that looks like the profit and loss chart of just buying a long call on E-Trade. This typically leads to questions, ideas, even criticisms of the radioactive position. An investor will look at the initial structure and say, a long call is the same exact strategy, but better. How can something be the same but better? Definitions don't really add up in that equation. But let's look at the argument. The argument is the long call costs less. I don't have to buy the stock and buy the put. I can simply buy the call option. Therefore, it is a better use of investing capital. Because I'm not putting up thousands of dollars to purchase the stock, I can diversify more and buy more long calls on multiple underlying positions to be more diversified. If the stock moves up 10% because I'm using leverage for the long call option, that means that the gain that I see is going to be a higher percentage leverage gain for the exact same similar profit and loss chart. And the risk of the long call is you can only lose what you put into the position. Otherwise, it's a parity trade to the married put position, but it's better because it costs less. You can diversify more. You see higher percentage gains, and you can only lose a small amount. Well, let's take a look. On the same day I may have opened that RadioActive Married Put on E-Trade, we could have also entered into the long call position. So on March 27th, I could have bought the 2019 January 60 strike call on E-Trade for $4.50. Again, this was the natural ask price. We're not looking at the midpoint prices here. If I bought one contract of the January 60 call, I'd pay out $4.50, or a total of $450. My risk up front is $4.50. Again, that would really only happen if I held this position all the way to January 2019. The stock was trading below $60 per share, and I made no adjustments between now and then. But it's a known risk of only $4.50. The profit is still infinite. If the stock moves up 10, 20, or 30%, I can still take advantage of high upside leveraged gains. Now, when I enter this position, I do want to be careful that the long call only represents maybe 2 to 3% of my total portfolio value. If I was trading in a $40,000 account, I may only want to buy 1 or 2 contracts of this position to pay $450 or $900. So if I do lose the full amount, it only represents 2 to 3% of my total portfolio. Look at the structure side by side. On the left is our long call position, the same but better trade to the married put radioactive position that is on the right-hand side. Total cost for the long call is $450 versus $6,365 or so for the married put. So we're using about 1/15 of capital to enter into the long call position. The maximum risk on the long call is $450 versus about $365 or so for the married put transaction. But I am risking 100% of what I put into the long call position versus RadioActive Trade, where I'm only risking 5.8% of the capital invested. Both offer an infinite max profit. If I bought the long call, I'm using $450 of capital for one contract, whereas the RadioActive Trade would use $6,365 for 100 shares and one put option to protect those 100 shares. Both offer infinite upside profit potential. Because the long call uses leverage, there's a chance for a high potential percent return. The stock moves up 10%, we might see an 85 or 100% gain on what we invested in the long call. Whereas on the married put, if we saw a 10% gain in the stock, we'd still see a 5.5%, maybe 6% or 7% gain on the married put position. Both have a known risk. You know up front what is the maximum loss on either position. The long call risks 100% of what you invest into the trade. Married put is a single-digit percentage risk, around 5 or 6%. Why is the percentage risk important? You're using leverage to set up a quote-unquote better trade. The same, but better. But leverage works both ways, and many investors find themselves getting trapped into the lie of leverage. If I have a 10% loss on any position, I don't need a 10% gain to get back to break even. I actually need over an 11% gain. If you and I invested $10,000 into a position and we lost 10%, we'd be left with $9,000. We reinvest that into a new position and the stock moves up 10%, well, now we're at $9,900. We're still short of the $10,000 we started off with. And this is a slippery slope. If I take a 25% loss on a position from an unexpected event or using a leveraged spread trade. On what I have remaining, I need a 33% gain to get back to break even. And if we suffer a 33% loss, our $10,000 drops to $6,700, I now need a 50% gain, $3,300 or so, in order to get back to that $10,000. And of course, if you take a 50% loss, you're going to need a 100% gain on your remaining capital just to get back to square one. If I take a 5% loss on a properly structured position, I only need a 5.3% gain to get back to break even, which is much more realistic. Everyone wants a better way to trade. You see a technique. You see someone discuss a new type of strategy or a new structure of a strategy that you're already comfortable with and you've already researched. You have the knowledge, you've traded options, you want to improve it. You've seen other things that can be done in a similar structure that might improve results, generate more income, and we see these questions all the time. And they are the right ones to ask when looking at any strategy, but you have to be careful of assumptions you make. Here's an email we received recently from a blueprint owner and RadioActive trader. LC says, I've been going through the blueprint and you do not recommend using call options to replace the stocks for setting up the radioactive profit machine, as you want to avoid a risk of overtrading. However, I wonder if the advantages of using call options overweight the drawbacks. What are some of the advantages? Well, we've seen some recent YouTube comments from an older video back in 2015 called Flailing Around with Covered Calls. And the YouTube commenter started off with, I'm missing something here. I just wasted over an hour watching a complicated alternative to buying a call option. It's the same exact thing. Unlimited upside, downside risk is only a couple of bucks that you paid for the option. Let's look at the two trades structured in a portfolio setup. Let's say you and I both have roughly a $100,000 account. And right now we're sitting on $15,000 of free capital to enter a new trade. I see the E-Trade Married Put. The RPM cost of the stock at 55.65 or so, and the put option at 8.05 would be 63.68. I'm buying a 60 strike put, so the most I can lose is $3.68, or 5.8% of my per share investment. With $15,000 of free capital, I can afford to buy 200 shares of E-Trade and 2 put options. Total investment would be $12,736. So the maximum risk, if I exercise those 2 puts, I guaranteed to get $12,000 back. So the maximum risk is $736, or less than 1% of my total portfolio value. On the right-hand side, we have the exact same account size, $100,000 total in all positions that are open, and we're sitting on $15,000 of free capital. The January 2019 60 strike call on E-Trade was $4.50. Well, so the risk is $4.50, 100% of what I invested. I can afford to buy 33 contracts, which would make a total investment of $14,850. But I'm risking that full amount, or 14.9% of my total portfolio value. That was obviously an exaggeration. I know you would not buy 33 contracts of one position if you had the full capital to allocate to, no matter how bullish you were. But let's be honest about the nature of an investor, specifically a leveraged call buyer, put buyer, or spread trader. If you are even disciplined enough to only buy 1 or 2 contracts of that E-Trade 60 strike call, what are you going to do with the remaining $15,000 or so of capital that's in your account? Do you put it on hold, not use it for any other transactions, or are you going to buy 4 calls of stock XYZ, 6 calls of stock ABC, and maybe 10 calls of stock 123? This is sort of the comment that I mentioned to the YouTuber who came in and said that the long call was better. Naturally, they came back with a reply. Let's take a look. Your speculation about how many calls one might buy has little to do with the fact that the actual monetary risk is the same, and a long call ties up far less capital. Proper portfolio management says that you should be diversified and not have a major portion of your total tied up in one trade. This prohibits the married put trade in small portfolios and makes it a bad idea even in large ones. If my risk on a trade is 300 and that's 1% of my account, then yes, I might buy a second call and risk 2%, but I still have only tied up $600, not a major portion of my money. Well, let's break this down, shall we? The speculation about how many calls one might buy has little to do with the actual monetary risk. Okay, remember, I am not arguing that the monetary risk is that different. We're about 50 cents off between the two in this one, but that's irrelevant. And I'm not arguing that. I'm not arguing that the long call ties up less capital. I'm not speculating that leverage investors buy too many calls. This is what I've seen for the past 16 years. Coaching sessions, webinars, phone calls, emails, and more as the Director of Education here at PowerOptions. It is the nature of an investor to place multiple contracts when they're buying long calls and puts and take up too much of their portfolio without considering the risk. When I usually receive a phone call and someone says, I need help repairing a long call, I come to find out they let the stock drop 20% and they have 30 or 40 contracts in their portfolio on one position that they were really bullish on, and they're taking a larger percentage loss than they can really afford to take. Let's move on to the next point. Proper portfolio management says you should be diversified and not have a major portion of your total tied up in one trade. Well, many examples that Ernie and I have done for the strategies that we support on PowerOptions, our picks of the day for covered calls and naked puts, we recommend only opening 2 or 3 trades for that part of your portfolio. Because every time that I've done tests or historical testing opening up 5 bull put credit spreads or 10 bull put credit spreads instead of 2 or 3, the returns are always less. You're entering more chances for positions to move against you and take larger losses in these leveraged positions. To this directly, proper portfolio management says that you should be diversified, but proper portfolio management also dictates that a larger portion of your entire portfolio should never be in positions that can lose 50% or 100% of what you invest. And of course, we have one more follow-up to that. The YouTuber commented, I understand how the numbers work, but it doesn't change the fact that you're tying up huge amounts of capital for the same trade. I had shown an example for Applied Materials AMAT comparing a married put to a long call. And the comment was the married put on AMAT uses over 1,300% more capital. And the difference of potential loss was just 54 cents. We see similar numbers, of course, with the E-Trade example we just looked at. So the commenter says you can play a numbers game with percentages all day, but in the end, what matters is actual dollars. You've tied up a huge difference in capital to save 54 cents, but it gets worse because you also had 2 commissions for the stock and the put, and you'll have 2 more to close the trade unless the put expires worthless, as you hope. Real quick, I'm not hoping the put expires worthless. Yes, I'm hoping the stock moves up, but I'm never going to hold this transaction all the way to expiration. I'm likely to close it well before expiration and take the profits and move on, or readjust before I lose all the time value on the put. But it is 2 commissions to 1. I'm not arguing that idea either. Yes, a larger capital is being used. The key here, and what I absolutely agree with, is but in the end, what matters is actual dollars. Let's take a look at actual dollars. On PowerOptions, we show our default screen for what we would use to open a new married put position based on the criteria and the structure of the combination. Using the historical tools on PowerOptions, I went back and selected the top 2 married puts roughly every 14 days starting at the beginning of 2018. On January 2nd, I would have opened a married put on Twitter and TAL Education Group. On January 16th, I would have opened a Married Put on Integris and SSNC. February 2nd, roughly 14 days later, I would have opened Married Puts on Planet Fitness, PLNT, and Grubhub. February 20th would have been NYT, New York Times, and Interactive Brokers, IBKR. And on May 5th, the top couple results were PayPal and Ameritrade, AMTD. Let's take a quick look at the actual trades we would have entered following the Married Put screen. January 2nd, TAL Education Group, 100 shares of stock at 30.27, would have bought a January 35 put for 7.80. Total invested is 38.07, 3.07 at risk, or 8.1%. On Twitter, 24.51 per share. Purchasing the June 26 put still matched our criteria. Total investment of 28.31, but with a 26 put, we're only risking 2.31 or 8.2%. January 16th, Integris, $32.30 stock. August 35 put for 4.90. Total invested 37.20. Maximum risk 220 or 5.9%. And SSNC Technologies, $48.50 stock roughly. July 50 put for 4.80. Maximum risk 6.2%. In February, Grubhub at 70.65, an expensive September 75 put at 11.40. This risk is up to 8.6% of the invested capital. Planet Fitness, almost $34 per share, an August 35 put for 4.20. Total invested 38.11, maximum risk $311 or 8.2%. February 20th, Interactive Brokers, 7,497 invested, maximum risk $497 or 6.6%. New York Times, $25 stock, December 27 put around $4, 29.05 invested, maximum risk 205, 7.1%. And lastly, on March 5th, TD Ameritrade 58.15, August 60 put at 5.20, 6,335 invested, a similar position to what we saw with E-Trade there, and a risk of 335 or 5.3%. PayPal at 79.07, total invested $8,942. Maximum risk only 692 or 7.7%. Those are the 10 trades I would have opened, opening 2 new positions roughly every 14 days from the beginning of the year. I would have required about $60,000 for 10 trades. The actual monetary amount invested was $53,400 and some. But I would have left 10%, $6,620 on hold to make adjustments if necessary to the put option or for other income methods that are discussed in the blueprint. But no adjustments were made on these 10 positions going forward. We see the Married Put structure and the moneyness involved. What would your parity portfolio or the same but better portfolio look like by just buying long calls? Same positions, same prices, using the natural ask, not using the midpoint for the Married Put or for the long call. On January 2nd, TAL, January 35 call is at 380. The risk on the RPM was only 307. Twitter, June 26 call, parity to the stock and the June 26 put, was priced at 253. It was a 231 risk on the Married Put. SSNC, July 50 call at 380. ENTG, August 35 at 230. A little bit less risk on the Married Put position for both. Grubhub, 75 September call on February 2nd was 840. And the Planet Fitness August 35 call on February 2nd was 350. IBKR September 70 call, 560. We're on February 20th now. New York Times December 27 call, 255. Ask price on February 20th. And the last 2 of the 10 trades, the Ameritrade AMTD August 60 call on March 5th was $3.50. A little bit less risk on the RPM. And the PayPal January 82.50 call was at 8.90 on March 5th. Let's take a look at maybe where we stand now. Just looking at the 10 positions, no adjustments made, not accounting for any dividends that might have been received. We can see here where we stand right now with the Married Put portfolio. 20 lines, here's our 10 positions. On the right-hand side, you see the total invested for each position and the current liquidation value if I sold to close the stock and sold to close the put at the bid price. Well, of the 10 trades, we see that 1, 2, Entegris, Grubhub, later on Planet Fitness, SS&C Technologies, TAL Education, and Twitter all have profits. We're all in the green. We have 4 losers. TD Ameritrade, well, that's right about at break even. Interactive Brokers at a small loss of only 1%. New York Times, the stock is down 6% from when we opened the position. We're at a liquidation value of 3.1%, and PayPal's at a loss of 2.4%. So we have about 60% win ratio so far. Down at the bottom, we can see that total cost of $53,381. And of course, the total market value, if I liquidated everything, total portfolio value, $62,777.48. With a starting of $60,000, we're currently at a 4.6% return with no adjustments and leaving the positions alone. So the total cost in was $53,381. Largest loss right now is a loss of 3% on New York Times. We're about 90 days in, although only those ones opened on January 2nd are a little bit more than 90 days in to trading. Current return, if we liquidate it, is 4.6%, profit of $2,777.48 on $60,000, and 11% of that money is still on hold for adjustments. Same day, same view, but the Parity long calls. Naturally, if 6 out of 10 of the married puts are successful in the underlying stocks, well, 6 out of 10 of the long call positions are going to be profitable as well. ENTG, a huge return on Grubhub, 250+% return on that position. Planet Fitness, 53% gain. SS&C, 175% return on the long call. TAL, 80.3%. And Twitter is an 89, let's just call it a 90% return. And we have 4 losses, 5% on AMTD, almost 6%, 16% on IBKR, 29.5% on PayPal, and that NYT position is at a 43.1% loss. Now, our total cost for all the long calls, keeping it parity, only 1 contract for each position versus 100 shares and 1 put, is $4,288 compared to about the $53,400 I would have used for the married put. The total portfolio value right now is $17,759.50. We started this with a $15,000, a portfolio 1/4 of the size what would be needed for the married puts. So we're looking at an 18.4% gain. So a quick summary of that Parity, cheaper but better portfolio. Total monetary cost was about $4,300. We used a $15,000 portfolio, 1/4 of the RPM. Kept cost to 1 contract for each position to keep that risk per position under 3 or 4% of the total portfolio. Largest liquidation loss is 43% on NYT. Remember, that's the lie of leverage. I'm only at a 3.1% liquidation loss for the married put on NYT. Current return is 18.4% of the total portfolio, but we can look at it as a profit of $2,759 on $15,000. Or you could say, well, it's $2,759 profit on $4,300 invested, so we're well above 50% return on what was invested, versus a profit of $2,777 on the RadioActive portfolio in the same 10 underlying positions opened at the same time. So the actual dollar difference is not that different. It's a little bit higher on the married put. But didn't I just prove the point for the YouTube commenter and the question that came in via email? Long calls are better. You used less capital, only $4,300 to make that same $2,750 profit. Really, it's 50% of what is invested if you think about it, and that's amazing. But the return alone, $60,000 portfolio for the married puts versus $15,000 for the long calls, the return's 18.4%, 4 times higher than what I'm showing in my married put portfolio. And because you only used about a third of the capital here, you could have opened more trades than those initial 10, satisfying that whole diversification thing. Really, this argument is over, and I can end the presentation right now, and we can say long calls are better. And unfortunately, that's what most people do. Let's put on those brakes for a moment. When we talked about the lie of leverage. When using leverage, you need to avoid taking those losses of 30%, 40%, 50%, and you definitely wouldn't stay in a position and risk 100%. What are you going to use as a stop for your leveraged long calls or leveraged long put positions if you're bearish? I asked that question on one of our recent Friday open discussions after the market closes. The question was, where would you set a stop loss on a long call or a long put? Would you set it at 25% of the capital invested to close the position, to not take a higher percentage loss? Would you set it about 33%? Remember, you'd need a 50% gain on your next position to get back to break even. Would you set your stop at 40% of what you invested into those long calls, or would you set it at 50%, or are you interested or possibly using a different number? So there was the poll that we asked, and here were the results. 23% of those who joined us in that presentation said they would set their stop at 25%, meaning if I paid $1 for that long call, I'm going to close it if the value of the call drops to 75 cents. 23% would have set their stop at 33%, allowing more wiggle room, of course, to allow fluctuations. 15% of the audience would have set it at 40%, and 31% of the audience would have set the stops at 50%. Now, 8% of the audience set a different number. And I asked, well, send in what your values would be if you send in a different number. One gentleman said he'd put in 10% because he didn't want to risk any money. Well, you're probably going to get closed right away due to the bid-ask spread alone of the option. If you enter at the ask and your brokerage closes your stops or your contingent orders based on the bid price for an option you bought, guess what? You're already out when you open the position just due to the bid-ask spread or a little fluctuation. One gentleman said 15%. Which would be very tough to do as well. And another one set their stop at 85%. In addition to actual dollars mattering, what actually matters is an actual trading plan. Because what happened between January 1st and roughly March 27th when I might have opened the E-Trade position? On February 5th through 9th, we saw a decay in the larger markets due to an influx of volatility, a quick snap there, and other concerns. Markets came back up shortly after that, and starting in March 20th, we got into sort of this fear of tech and this little fear and hesitation in the market over a trade war and tariffs with China. And we saw another quick decline as well. Now you're looking at roughly a 3-month chart here of SPY, of course, Standard & Poor's 500 ETF. What does this do to a married put portfolio or a long call portfolio? Here's what likely would have happened with the 10 positions that you had opened. Now remember, 60% of the audience that was polled said they would have closed their position if they had hit near a 40% loss. 15% would have set their stop at 40%, 23% apiece for 33 and 25. Only 31% said they'd set their stop at 50. But let's take a look. Here's what likely would have happened. That TAL position opened on January 2nd would have been closed on January 23rd for a loss of 39%. It was 40% during the day, but it was 39% at the close. Same with Twitter. And this was before the February collapse, really, that happened between February 5th and February 9th. The calls that were open on January 16th, SSNC and ETNG, would have both hit a 50% loss on 2.5 and 2.8. Now, I could have set a date. I would have used a date if this closed for only 40%, but it didn't, because that first fluctuation happened at 2.5, and this immediately went from a small gain to a loss of 52%. Any of those stops you hit would have been triggered. ENTG, same thing on 2.8, it fell below the 50% loss. On February 7th, the Grubhub position that was just open 5 days later hit a loss of 35.7% at the close, but was a loss of 42% intraday. Planet Fitness suddenly, just like ENTG, on February 8th went to a full loss of 62.8%, where it was only 20% or so the day before. So now it hit my stop. I've got to close it, but I'm taking closer to a 63% loss. The Interactive Brokers long call is still open. It was opened on February 20th, but it was down 21% on 3-1. Most of investors wouldn't have closed it at that time. The NYT call, of course, was closed on 3-1 for a loss of 37%. We saw how right now it would have been a loss of 43%, but we would have closed it maybe at 35 or so. The Ameritrade long call is still open. The PayPal long call is still open as well. So although 6 out of 10 of the positions that would have been open from January 2nd to March 5th, 6 out of the 10 were profitable and moved up, in a real long call portfolio, you would have closed 7 of the 10 positions because they hit the stop, because you can't afford to take those 40, 45, and 50% losses or higher. Your stops would have been triggered. What are we left with? Well, we're left with the AMTD long call, which is still showing a profit of 8.6%. The IBKR position, still open, but is currently at a liquidation loss of about 11%. And PayPal is getting closer to that loss. It's at 28%. That 23% using a 25% stop would have closed this one as well. Others are still in. But with actual dollars and an actual trading plan, we see a loss on this portfolio of 9.5%. The $15,000 portfolio we started off with is only $13,578. Or I can say that that $4,200 that was used to invest in these positions, the $4,300 that were invested into those 10 positions, is now a negative $1,520, including the losses that were taken. That's 35% down, isn't it? Well, let's take a look. Here are all the closed transactions. Loss of 37.3% on NYT roughly. 62.9 we saw on Planet Fitness. The 35.7 we saw on Grubhub, which did go to 40, but we're just going to use the close. 52.5% on SSNC. 50% on ENTG. Almost 40% on Twitter and TAL. Those biggest losses that we see. Planet Fitness at 62.9%, which would have been closed on February 8th, and SSNC at 52.6%. On those same days, the Planet RPM was a loss of 202, similar money, but only 5.3% of what I invested in the position if I liquidated at that time. SSNC was at a loss of $1.94, or 3.6%. Wouldn't have hit my triggers to close those positions. Because the maximum risk I could take on the position, although Planet Fitness was close, I still had several months to wait. And I'm only looking at a 5.3% loss, which means I only need 5.8 or a 5.9% gain to get back to break even. The actual dollars do matter. I completely agree with the YouTube commenter, and in the sense that an actual and likely trading plan matters as well. When you use leverage positions, leverage works both ways. Losses will tend to overtake the gains. Then, of course, the natural follow-up is, but I would have managed those losing long calls. I would have rolled down or bought calls at a lower strike to ladder down the cost average, or maybe I would have bought a put or sold a call. All right, well, there goes that whole married puts have the extra commissions argument, because you were already planning on doing some management if X or Y, and so was I. But that's the nature of trading. The RPMs could have been managed as well, and some now would actually be bulletproof, meaning we would have canceled all of the risk on the positions by manipulating the put or doing other adjustments as well. The summary: does buying a long call use less capital and have a similar risk-reward profile to the RadioActive Married Put that we use? Absolutely, and I'm not arguing that. Here again, the E-Trade comparison. On March 27th, I could have bought the January 60 call for $4.50 per contract, which would have only been an investment of $450, giving me a known risk and unlimited upside profit. Whereas the married put position would have had that total cost of $6,300.68 per share, $6,368, where my maximum risk was 5.8% on the position, but I still have infinite upside profit potential. Can you diversify more using long calls? Thus, it is a better use of capital. Yes, and then no. If you close those losing long calls and open more after the February decline because you thought the market had settled, you would have been hurt more in the March decline on more of those positions. More positions would have lost, the lie of leverage would have taken over, and the long call portfolio would have been much lower, into losses of 20, 25, possibly even 35% of where you started. I'm still a profit on the married put positions of 4.6%. And had you opened 10 positions, instead of only using $4,300 of your total portfolio, when we talked about that $15,000 leverage portfolio, but if you'd opened 10 positions on January 2nd, January 16th, February 2nd, ouch, you would have been much lower and taken out much more of your capital and needed much larger gains to make that back. And then, when you thought the market was recovering, you would have been hit again on the March cycle around March 20th, seeing similar declines on that leverage portfolio. Does it use less commissions than a married put RadioActive trade? Does just buying a call use less commissions? It's 2-to-1. I'm paying a commission to buy the stock in the put. You might be paying a commission just to buy the call. We're not arguing that either. But if management is needed, is part of the trading plan, and it should be and it will be, we can toss those out the window. But if your account is so small that you're worried about the cost of 2 commissions over 1, I encourage you to save more money and trade later. You'll be better off in the long run. Commissions are the price of doing business. Just because a strategy offers 2 or 3 commissions doesn't mean it's a worse strategy for your portfolio. That being said, if you're trying to do weekly ratio spreads versus weekly vertical spreads, then we can look at it 3 commissions versus 2 commissions when your max profit is only 10 or 15 cents per contract for a vertical spread or for a ratio spread. That I can understand. But in this case, longer term, 1 commission versus 2 commission, not really there. If you're worried about commissions, again, I encourage you to save more, trade later. You'll be better off in the long run, and you won't be worried about the cost of business to trade affecting your returns. What matters is actual dollars. I couldn't agree more. And I think I've shown by how controlling risk properly, avoiding the lie of leverage, puts you ahead and stacks the market odds in your favor in the long run. Leverage works both ways. And although the YouTube commenter was very strict and seemed that they were going to be very good about being disciplined in trading and making sure no long call represented more than 1 or 2% of that portfolio, that is not the nature of a leveraged investor that I usually come across who might call up for help with a position that's losing 35, 45, or 50%, and they need a miracle fix. Of course, I help them with that. That's my job here at PowerOptions. But the nature of the investor is to overtrade when they're using leverage. We've talked about how you can't take 50% losses, which can happen often with the not parity trade long call. So am I saying you should never trade long calls? No, I'm not really saying that either. But to get ahead, to put the market odds in your favor, I feel the bulk of your account or a large portion of your account should be in protected positions that control risk up front and force you not to overtrade, specifically the radioactive positions. Over the past 8 or 9 years, about 50 to 60% of my trading portfolio is dedicated to the radioactive trades. But I do use vertical spreads, calendar spreads, and other option strategies with that remaining portion of my portfolio. Radioactive trading is capital intensive. But to tell you the truth, I'm not opening a radioactive trade, a married put position on Amazon, $1,500 per share, Priceline, or any high-priced stocks. I will likely use a calendar spread for those positions, keeping in mind that that strategy also falls into the lie of leverage. So only 10 to 15% of my total portfolio value will be allocated to maybe 2 or 3 calendar spreads on larger price stocks. But the bulk of your portfolio should be protected where you control the protection and you control the insurance much better than a stop order, because the radioactive married put guarantees you can't lose more than that 5 or 6% of the initial structure. And you still have the opportunity to do many different adjustments against it without adding to the risk, generating income, and in fact, lowering that risk. If you would like to know more about how to properly limit risk in your portfolio and avoid the lie of leverage that comes with these other strategies, go to RadioActiveTrading.com, just put in your name and email address, and click that button that says Get the Sketch. This is a free white paper, an introduction to the limited risk trading techniques. If you want the full story, you'll want to go ahead and click on the products and check out the blueprint. The blueprint is the full work that describes the initial married put structure that we use to properly limit risk, set time on our side, and how and when to use the 12 different income methods in the limited risk structure to lower that initial at risk, generate income, and potentially bulletproof the trade. The blueprint is over 250 pages detailing step by step how to implement this trading strategy, when, how, and why to use those 12 different income methods. Special chapter, of course, on combining income methods, as well as a special chapter on exiting the radioactive trade. Of course, there's also several appendices, including chart reading, income method decision table, and more. Now, why 12 income methods? Of the 12 different income methods discussed to use against the limited risk structure, some are best used if the stock moves up as you're expecting. Some are used if the stock is stagnating and is not moving the way you expected, and there are even income methods you can use if the stock has fallen to lower the cost basis on the position, generate income, or to profit in both directions depending on your outlook on the stock going forward. So what are your thoughts? Now, I designed this presentation to help answer those questions that come in on comparing the long call to the radioactive married put. And they are the correct questions to ask. And I asked the same things when I was first introduced to the radioactive trading techniques back in 2007. But at the end, when you look at the comparisons, you look at an actual trading plan and what you likely would have actually done. Is the long call really a parity to the married put position? Is it the same but better? Actually, I think we've just shown that the married put is actually better, even though it is more capital intensive, because in a real trading market, we might be looking at a loss of 10, 15, or 20% with leverage long calls. The same time period, we're almost at a 5% gain, the same starting positions on a radioactive trade. No fear of market corrections, black swan events, going through earnings. You're avoiding the lie of leverage. But again, I want to know your thoughts on what you feel I missed in this comparison and I'd love to address that as well. Leave us a comment with your thoughts. Send me an email anytime to support@radioactivetrading.com, or you can always call us during market hours at 302-992-7971. Thank you for joining me for this almost hour-long presentation again. I hope you enjoyed the presentation, got some useful information for your portfolio, and I look forward to your comments in the future.